You need your iPad
No.
or?
Thank you, Chair Powell, for the excellent remarks in the Adam Smith address. And we will have about half an hour for questions. So
Sounds like a long
should have
time.
talked longer. So let me start with, before I go to some of the questions coming in from the audience, and do use the Connect app to generate those. You have said, and you repeated again here, that there are no risk-free paths for the Fed now. So in light of that, and in particular, with where the recent inflation data are running, let me group this with some of the questions that we're seeing coming in on the app as well. Obviously, always data dependent, but thinking about the dual mandate of maximum employment and price stability, how concerned are you that if the rate of pass-through of tariffs is slower, that might begin to look like more persistent inflation, as opposed to a one-time, as if the tariff adjustment came through all at once, and then it would be quite clearly a one-time price level shift?
So that's certainly a risk. You know, as I mentioned, there really isn't a risk-free path now, since it appears that inflation is certainly running above our target, and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined. And, you know, both the supply and demand for labor has declined quite sharply. So, you know, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has been that policy should move from being, you know, tight to some degree to being more neutral as those two things balance out. But it is clear, though, that, you know, if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. If we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that, which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Let's move to the other risk then and talk about employment a little bit. We had Anna Paulson here yesterday, and she spoke about the break-even unemployment, employment growth rate. And that's a question from the audience as well. So I believe she said that it's certainly lower than it was, and the standard error around those estimates probably includes some numbers that might even be negative. Where do you see the monthly break-even employment growth rate at this point?
I'm not going to try to give you a pinpoint number, but as you pointed out, the standard error around these things is, you know, 50,000 plus or minus, something like that. And, you know, that would certainly, I think the range of plausible numbers for the break-even rate is probably does go below zero, accounting for those standard errors. It's clearly come down a great deal. And that's what's so challenging about this, is that both supply and demand in the labor market have come down so sharply, so quickly. And the fact that the unemployment rate has barely moved is kind of remarkable in and of itself, and suggests that they're moving at roughly the same pace, although, of course, the unemployment rate has ticked up, which suggests that demand is moving a little faster than supply. I wouldn't want to point to a specific number other than to say that it's come way down. And there are many estimates out there. By the way, there are many ways to calculate it, so you're going to get different estimates.
We're certainly in a volatile and changing environment. So one question I have is whether you see any changes in the transmission mechanism of monetary policy actions. So when we speak of long and variable lags, as we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so I might have to come back to you. That's right. So on transmission, there, in theory at least, I see 2 things. One is, what we say and what the actions that we take on monetary policy and how quickly that gets into financial markets. So if you go back to when I was in college, that part would have taken, weeks, months probably. And now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that has probably blunted the transmission of lower rates into that part of the economy. But overall, I think it still works the way we think it works, which is, long and variable lags means a lot of uncertainty about how it's being affected. I think the last part of your question, the lore has been that inflation and employment come later. The first decisions are purchasing decisions, hiring decisions, and things. Well, purchasing decisions, can be affected probably more quickly. But then those would eventually affect employment and inflation. So longer lags are when the research generally shows longer and longer lags for employment and inflation.
And I guess the variable part of that comment does give us a bit of cover.
A lot of uncertainty.
So you spoke about the adjustments or the challenges that you're facing with some government data not currently being published. Beyond the headline unemployment rate, which we're not going to see right away, what other labor market indicators are you monitoring most closely to gauge that side of the mandate?
So I think everyone's looking at the same non-government data. So there's a set of non-government data around, or non-federal government data around labor markets. For example, state level unemployment, claim reports. You can add those up and get a pretty decent estimate, and that's a really good one. There's also ADP has its data and employment. So in the employment space, there's some plausible data. I will say generally the private data, the alternative data that we look at, is better used as a supplement for the underlying governmental data, which is the gold standard, and it won't be as effective as the main course as it would have been as a supplement. So we don't expect that we'd be able to replace the data we're not getting. So I think in job, in employment space, there's some pretty good substitutes, less so in inflation space and in economic activity space. And also they're just, they're different private data providers use different universes and different levels of rigor in their data analysis. So, we're looking at lots of things, and we're going to make our decisions according to the FOMC schedule. But I think it will be a lot better once we start getting, for example, the September employment report is going to be a very important report, and we're not on track to have that. There would still be time for us to get that. We will get, of course, the September inflation, the CPI and PPI reports. So that's a positive. But we don't comment on fiscal matters, but from our standpoint, we'll start to miss that data, and particularly the October data. If this goes on for a while, they won't be collecting it, and it could become more challenging.
You used the term gold standard, and you didn't mean it in this context, but I'm going to pivot here because there's a question from the audience that's getting a lot of upvotes. So one of your predecessors, Alan Greenspan, used to view the price of gold as an indicator of inflation risk. So in that context, how do you view the rally that we've seen in gold? And if you want to throw in Bitcoin, you can comment on that too.
I'm not going to comment on any particular asset price, including that one. And I think we think of inflation as driven by fundamental supply and demand factors, and it's not something we look at, actively.
Fair. The September projections, we saw revised GDP growth projections revised upward for both 2025 and 2026. Now, sometimes it's just an issue to issue thing, but how do you reconcile that projection of stronger growth with what we're seeing in terms of a likely weakening labor market?
So even subsequent to the September SEP, we've seen economic activity data which are surprising to the upside. And as I mentioned in my remarks, so you do have a bit of a tension there between the labor market data that we see, very low levels of job creation, and yet people are spending. So economic activity is strong, and it's we're going to have to see how that plays out. Right now, of course, we're not getting any new government data on that, any new federal government data on that, but it does create, of course, if economic activity were stronger, then that would tend to support labor market activities and hiring. So we'll have to see how that works out.
Another topic that has permeated the conference over the last 2 days has been AI. So as the Federal Reserve, like all of us, grapple with the implications of generative AI, what plans are in place to assess its long-term impact on productivity, implications for labor markets, and overall economic stability? And does that present any new risks to monetary policy or financial stability?
So you're right. We're doing what other people are doing, which is reading all the things so many researchers are working on AI now. It's just amazing. And so we follow all of that. We also have people at the Fed who are doing lots and lots of research on AI. And, in terms of, it's just such early days to be looking for the kind of things that will happen. So, the question of productivity, it was Robert Solow who said that technology is showing up everywhere, but in the productivity data. So this could be the same kind of thing where it's there, but it takes a long time kind of to show itself, because you would think of another big technological advances potentially raising productivity, but I think it's early to say that we're seeing it. Also, you're seeing, I think some researchers have found effects on hiring from AI for entry-level people and for coders and things like that. So there's probably some of that out there, but it's just so early to say what it will be. We also monitor very carefully what public companies are saying. Increasingly bold statements from mainly large private companies on things that they think they can do across their whole business area with AI, and either sort of freeze hiring where it is or reduce hiring. And I think we're pretty aware of what the potential outcomes are, but the range of potential outcomes is very broad. I will say, in terms of what the Fed can do, we deal with supply and demand. We have interest rate, and we also do regulation, that kind of thing. But if what's needed is greater education and skills, I've always liked the model that technology can work for everybody as long as everybody's getting the skills and aptitudes they need to use that technology. This is Golden and Katz, their work, which they actually spoke about at Jackson Hole this year, but it's a 20-year-old book that they wrote. So we can't do that. That's not something the Fed can do. We also can't address the potential societal disruptions that could happen, potentially, if there's really significant job loss. So there are a lot of, we're the least of it. There are potentially really significant implications for people in the labor force. And I think we're all speculating about what those might be, but it's only the beginning of this story.
Yeah. Looking at some of the other questions that are getting upvoted, and you can get as far into the weeds as you want, but this is where people want to go. So let me try this one. As you think of the appropriate level of reserves in the system, what indicators are most important? Is it the price of money, so repo levels, or the volume of borrowings from the Fed, like the discount window, and so on?
So we have a nice spider chart and 5 main indicators, one of which is sort of repo levels. And I think overall what they're showing is that we're still at ample reserves. Abundant reserves. We're still at abundant reserves, meaning above our goal of ample reserves, a little bit above ample reserves. So, but we're beginning to see, you're starting to see a little bit of tightening in money market conditions, particularly repo rates have moved up. And those are the things we're going to be watching. So we think we're still at abundant, and we're, the pace of runoff is now very, very slow. So we're going to be watching all those factors very carefully. And we're not so far away now, but there's a ways to go.
I think we're not going to get away without addressing this one. So I'll try to, again, group some of these together. First, there's definitely appreciation from the audience, your ability to try to remain above the political fray. And I think also, and as in your remarks, you said gradually and predictably, and that sounds really nice right about now. But with that ongoing scrutiny of the policy decisions of the Fed, what measures is the Federal Reserve taking, and are you taking, to ensure and demonstrate the continued independence in setting monetary policy?
So the main thing we can continue to do is to do our work the way we've always done it, which is, think really carefully about evolving economic conditions and the evolving outlook and the balance of risks, and try to make good decisions to best serve the American public, and then explain those decisions and talk about them in a way that makes sense and is grounded in the data and our overall approach. I think we're going to keep doing that, and as long as we're doing that, people will be able to tell. If we start doing something else, I think people will be able to tell that too. But that's just not something we're ever going to do. We're always going to keep doing our work. We don't engage in back and forth with people. It's just not that gets to be political sort of right away. So we just do our work and do it as best we can. I mean, overall, I would say the Fed comes through the last, if you think about it, go back to the beginning of the global financial crisis. We've had two world historical crises back to back, essentially. And the U.S. economy, it's been quite a ride for the U.S. economy and for American citizens, but we've come through it as well or better than any other country in the world. And we had to innovate and did innovate. There was really no choice. We can look back now and as I did today and second guess ourselves, which is only appropriate. That we've been doing it for 10 years. Since I got to the Fed 12 years ago, we were already doing a lot of that. So that's an ongoing process. But I think if you take a step back, the Fed isn't a government agency that does a good job for the public that it serves. And that is our only goal. And I think we do it pretty well. Don't look for perfection. These are close calls that have to be made in real time. But I guess that's what I would say.
It's fantastic. And in that context, then internally to the FOMC, how important is it that you have consensus on it? I mean, we're economists. We understand the value of spirited debate, and but is that important in terms of communicating the results and the decisions of the committee?
I mean, consensus is great, but the most important thing of all is to get it right. And that you come to places, not very commonly, but sometimes you come to places where people are going to have different views, and this is one of them. You have a situation here where literally inflation's above target and gently rising. The labor market is subject to pretty clear downside risks. What do you do? How do you think about that? That's not a problem that you face very often in central banking or in the economy. And people are going to have different weights and different risk aversion and different risk appetites on those things. It would be kind of surprising if you had no debate over those things. So we have a healthy debate going on. I think it's very healthy. I think the meetings that we've been having are as good as any we've had, in terms of people sincerely, giving their absolute best argument for their positions, but they're different positions. That's, when I was an investor, I always felt like the most dangerous thing is if everybody agreed on something, because you need someone to come in and try to explain why this is a terrible idea. Hopefully somebody really smart. And that would give you the ability to really test your thinking. So I think that's a healthy discussion that we're having right now. And I'm not at all surprised that we have people across the board. I do think we also, as an institution, do try to come together around a central answer, and that's of course part of what I try to do is find an answer that will attract as much support as possible.
Absolutely. I know you probably won't want to comment in great detail on global conditions, but there are a few questions around that and what that implies for U.S. monetary policy, and also just looking at the interest rate differentials between the U.S. and other advanced economies, and how long that could persist, and is there a risk there?
Sorry,
the interest rate differentials between the U.S. and other advanced economies.
Yeah, I mean, we set interest rates according to, the place where our economy is domestically, taking into account the international aspects of our economy. So again, it's not surprising. I mean, you could name many, many factors, but, for example, tariffs are clearly more disinflationary for countries that are subjected to them, and they're more, I wouldn't say heavily inflationary, but there's some inflationary pass-through to consumers from countries that are putting tariffs on. So there's a very different monetary policy response potentially just in that. I think we need to set, as every other central bank does, they're setting rates in their, whatever their, remit is geographically, and they're going to be different answers. It's not unusual.
So we have a large number of young economists in the audience today. Could you talk a little bit about, as we look back, and it's a momentous award, it's a nice time to reflect. If you looked back on your early career and your early goals, how do you think that young Jerome Powell would view where Jerome Powell is sitting today as chair of the Federal Reserve?
Surprised. No, I would say, so what I would tell young economists is you've chosen a great profession, a tremendous profession. You're getting the tools to analyze public policy and what works and what doesn't work and what should be expected to work and wouldn't and why. And also what's the state of the economy. And guess what? It's not just hard, it's basically impossible. But it's a very, very difficult thing, but it yields itself up over time. And it's just an incredibly important subject that carries the capability to do really good things for the general public, who may not feel great gratitude toward economists, but sometimes. But no, it's really important. You've made a great choice, and I would say wish you the best of luck.
Thank you. Agree. Okay, we'll do a little bit of a lightning round here. We have about 5 minutes left, so I'll ask a bunch of questions that you may not want to get into great detail on anyway. Yeah. Some of these are pretty straightforward, but so we talked quite a bit about labor markets, but we have not specifically asked the question about the effect of immigration policies on labor supply. How restrictive do you think that current policy is, and is that something that will just
current immigration policy?
Yeah.
Yeah. Let me start by saying that we don't have a view on immigration. It's not our job to have a view. So we take that as completely, it is what it is. We take it as it arrives. More, I'd say, stronger policy than most people had expected. We've seen very sharp decline in growth of the labor force and in people entering the country, and yeah, I think you're only beginning to see the strength of that policy too. There's more expulsions; those are rising, and that kind of thing. So yeah, that's a big economic factor. So that will mean fewer people to work. You have anecdotal evidence of industries that are just having a hard time finding people. You don't see it in wages or anything like that at this point. You don't see, at least in the aggregate, you don't. But yeah, it's going to be a really important economic fact because that's new people who come into the workforce. They create their supply, but they also create demand. They create their own demand, and again, from our standpoint, we're just, our job is to achieve maximum employment or maximum sustainable employment. And that will depend both on the supply of workers and the demand for workers.
Back to the balance sheet, some questions. Again, I'll kind of try to group these together around mortgage-backed securities and housing affordability. Again, not directly part of the dual mandate, but would the Fed ever look at any specific actions with regard to MBS to address mortgage rates or affordability for housing?
The answer is, look, we look at overall inflation and we don't target housing prices. And also I don't know how you would, we would certainly not engage in mortgage-backed security purchases as a way of addressing mortgage rates or housing directly. That's not what we do. We do have, as I mentioned, a very large amount of mortgage-backed securities, and they're running off, but they run off pretty slowly.
Fair. Question on the beverage curve. Maybe that's not a lightning round question, but let's try it. So do you think that the shift in the beverage curve is a structural shift or just a blip?
I think it's, you're at a place where, further declines in job openings might very well start to show up in unemployment. You've had this amazing time where you came straight down, but I just think you're going to reach a point at which unemployment starts to go up. And we may be hitting that now, but it's been remarkable how that line, it just comes down, 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 down. And which has been, really a great part of the recovery.
All right. Well, we have just a couple minutes left. I think we'll end with maybe another sort of philosophical question. Michael Barr spoke to the policy conference in 2024, I believe it was, and he gave some advice to economists. What would your advice be to the economists in the room in terms of how we can best serve the challenges that are facing us collectively in this moment?
I'm inclined to say keep your heads up. It's a time when people are challenging expertise, and I think it's a distinguished profession. It's a very high order profession, and you should be proud of your work and keep at it. Ultimately, we're learning about how the economy works and how society works. Our understanding is so basic and so uncertain, really, still after all these years. But, you got to think we're making some progress and doing some good and imposing, sort of an analytical framework around the kind of decisions people make about the economy. So I just want to give you a vote of support and say, keep at it.
And likewise, NABE supports you.
Are we done?
We're done. Thank you so much.
Thank you. Thank you. Thank you very much. Nice.